guys, I'm Karunya Rao, and in Ideas for Profit, the spotlight is on HDFC Bank. Now, earlier this week, the Reserve Bank of India relaxed the restrictions placed on HDFC Bank on sourcing of new credit cards. However, restrictions on all new launches of digital business activities will continue till further review by the RBI. HDFC Bank stock, in the meanwhile, has significantly underperformed the broad benchmark following RBI's embargo since December 2020. While the Nifty has rallied 26% since the event, HDFC Bank stock has been a laggard and has risen by a mere 6% during the same period. So RBI's partial lifting of restrictions is a welcome move for the country's largest credit card issuer. So here's what happened. In early December, RBI banned HDFC Bank from issuing new credit cards and also stopped digital launches due to frequent outages in the bank's digital infrastructure. The regulator also appointed a third-party audit of the bank's IT systems, which is now complete. HDFC Bank's digital trouble started from tech downtime. However, on one occasion, the bank's services were interrupted as it underestimated growth in the payment volumes, and the disruption was more of a capacity issue. Now, the capacity issue doesn't come as a surprise given the fact that the bank has been at the forefront in the digitization process and has garnered humongous market share across multiple digital channels in the last few years. While HDFC Bank lost some market share in credit cards because of the ban, it continues to be a leader regardless of that. It is the largest credit card issuer in the company, both in terms of cards outstanding as well as spends as of June end. With a card base of around 1.5 crores, credit cards constituted around 5% of the bank's overall loan portfolio at the end of Q1. Historically, credit cards have been a key growth driver for HDFC Bank in the last decade. It has also been highly profitable for the bank. Since more than 80% of the cards are being sold to bank's existing customers post the appraisal of their credit history, credit costs are contained despite being an unsecured lending. Following the halt on sourcing new customers, HDFC Bank's credit card portfolio contracted 7% in the March to June period. Also, the ban impacted bank's margins as well as fee income. Credit cards are a high-yielding product and contribute around 25 to 30% to the bank's total fee income. The lifting of the ban will give some boost to bank's retail lending growth, which has decelerated to single digit since the past few quarters. Also, the upcoming festive season should augur well for credit cards business and consequently the overall loan growth of the bank. Interestingly, Citibank, which is the fifth largest player in credit cards, has decided to exit the business and is scouting for a buyer. Citi has built a strong presence in credit cards. It has around 6% market share in the total spends at the end of FY21. Though much smaller than HDFC Bank's market share of 31%, Citi's exit presents an opportunity to HDFC Bank to further cement its position in the business by either gaining Citi's existing clients or by acquiring its credit card business. With 3.67 crore debit cards, 1.49 crore credit cards, and about 21.3 lakh acceptance points as of FY21 end, HDFC Bank is among the largest facilitators of cashless payments in the country. The share of credit cards in digital payments has declined in the recent years as other electronic modes of payment such as e-wallets and even UPI have gained popularity with customers. But HDFC Bank is well prepared to deal with the likely disruption by offering an extensive suite of payment solutions to customers, which includes POS terminals, payment gateways, UPI, and QR in addition to cards. It is important to understand HDFC Bank's strength on the digital side, especially in the payments business, with Paytm's IPO that's likely to hit the street very soon. HDFC Bank has been leading through merchant acquisitions despite disruptive competition and has taken over the competition from fintech companies like Paytm operating in this space. HDFC Bank processes over 47% of total merchant transactions in the country. It aims to grow the current 21 lakh acceptance points network by 10 times in the next 3 to 5 years. At the current market price, HDFC Bank is trading at 2.9 times core book value estimated for FY23, assuming conservative earnings growth of 14% CAGR over the next 2 years. This is at a significant discount, way below its historical long-term average valuation multiple of around 3.5 times. Now, given that digitization has been an important marker for HDFC Bank's performance, RBI's embargo has been an overhang on the stock. Now, with partial lifting, HDFC Bank is back in the game as far as credit cards are concerned. Since the audit is already complete, hoping the matter gets fully resolved and the bank embarks on its digital journey, driving the stock price upward.